Pleasure to be here. I'm going to make a short presentation that's going to cover three areas. One will be around a very quick summary of the UK context, because I think it's important you understand the differences. One around fair finance and its products, and then a little bit about some of the learnings, because we're quite progressed in terms of where we are in our business model. So I'll go from there. So just some very, very basic statistics for you regarding the UK context. We have no such thing as financial exclusion in the United Kingdom. Everybody has access to finance. The only challenge is the price in which they pay for that access to the finance. We have what's known as a very booming subprime market, and currently somewhere between 1 in 7 to 1 in 10 of, actually no, it's maybe 1 in 6 of the total population has access to some form of subprime finance. Of these, about 2 million people don't have a bank account in the UK. Up to 5 million people are using a form of credit known as doorstep lending. I don't even know if this is available in other Western European countries, but this is where somebody comes to your house and offers you cash. It's a very, very personalized service. About 2 million are using payday loans. You may have come across these. These are short-term loans that are often on your mobile, online, very quick, very fast, with very, very high rates of interest. And about a couple of 100,000 people, so I mean a big number, but a small number in the scale of 60 million people in the UK, are borrowing from somebody who will just break your legs if you don't make the repayments. So just to give you a sense of what this interest rate range is, these are legal, legitimate companies in the United Kingdom. The first four are doorstep lending firms. The second one down is a FTSE-listed company that has 2.5 million clients in the United Kingdom and employs 55,000 people. These loans are typically £800 and they last for, sorry, these loans are typically £400 and they last for eight months. Payday, which is the very short-term finance, typically starts at 2,500% and then goes up. And these are usually for weeks or for months. So this is the kind of subprime market in the UK of non-mainstream finance. These are totally legal. These are completely legitimate. They comply with all the regulatory requirements of the UK credit laws, including affordability tests, transparency. All of these numbers are very clear. So just so you understand that, I just wanted to put that into context of the different environment that we sit in within the United Kingdom. Now, when you look at that, one of the things you probably think is that anybody who borrows money from these things must be really, really stupid. Because clearly, we should be educating them, right? Who borrows at 4 figures? That's a dumb thing to do. But if I told you that actually many of the people who use this financing use it for very, very sensible reasons, because they do not prioritize price as a key determinant in their choice of financial products. What they prioritize is access. And the fact is that many of the people using these forms of finance fail a credit score. And they fail a credit score because they have little or no income, they have little or no assets, they have little or no credit history, they don't even work. Or if they do work, they move in and out of employment, which means that they feature very low on a credit risk methodology. This is 7 million people in the United Kingdom, and it's rising. Partly due to the financial crash, this is increasing to probably 12 million people. Just as a kind of an aside, in the mid to late 90s, every single bank in the United Kingdom had a subprime arm. During the boom years of the noughties, they got rid of them because actually everybody was financially included. Now, post-2008, all these people are now being pushed back out. So these are not people who've never used banks. They have bank accounts. They just fail a credit risk model on a bank. And actually,
how do they repay then?
Repayment is a mixture of automatic, through direct debit collections, card payments, through or cash.
But how do they manage to repay if they have no income?
Well, they often receive social security benefits, which is a monthly income. Some of them work part-time, some of them move in and out of employment, and some of them work cash in hand. So there's a range of income. So everybody has an income, but they may not have a very big income. So when you speak to some of these people, what you find is that they are not idiots. They are quite carefully choosing an expensive lender rather than somebody who breaks their legs if they don't make the repayments. They're choosing an expensive lender because it gives them access to being able to buy a washing machine, a cooker, a christening present, a school uniform, or even sometimes a deposit on creating a business. This is the reality for a lot of people in the United Kingdom. I don't doubt that this is the reality in many, many other countries. There's just a much, much clearer, transparent market in the United Kingdom for using this kind of finance. I launched Fair Finance in 2005, and I'm just going to take you through the kind of approach around the products, the design, and what we've managed to do. My sense is that the reason people stay excluded is because nobody's ever bothered to design a decent product for them. Nobody's ever really thought about what are these priorities that they require. Accessibility, flexibility, a bespoke financial product. Nobody's ever really thought about that except people who are willing to charge them a high rate. And by virtue of this, and by the virtue of the fact that these companies share no data on your borrowing habits, it means that many of these people are never able to escape these extortionate lending practices. They stay stuck within them. Fair Finance is trying to innovate new financial products within this market, and we offer 3 products. We have a subsidiary charity which offers free money and debt advice. We deal with about 1,000 people per year on this. We have a personal finance program which is competing directly with the payday and doorstep and high-cost lenders. Loans averaging around £500 for a year at an interest rate of between 39% and 59%. With an admin fee of 5%, this gives you an annualized APR of 71% on a loan. To give you a sense of what that means, a £500 loan for 12 months will cost you £100 of interest. It's not the same as 71% of 500. It's a declining balance, and the APR calculation is a clear indication of comparison. Okay, so we have an unsecured lending product for people borrowing short-term consumer finance up to a year, but typically the loan is about 8 months. The APR is around 71%. And we have a microcredit product, which is I won't repeat it, it's very similar to the one that MicroStart is providing, PerMicro and many other MFIs. Loans of up to 20K, but really they average 5, maybe 7,000. The term is up to 36 months, but really it's averaging around 28 to 30 months. The loan is obviously unsecured, and we charge between 19 and 21%. With a small admin fee of 2%, this makes an APR of around 23%. We've run these products since 2005, and in 2010, we realized that actually it was possible to make these sustainable, but you needed to focus and do it properly. So in 2010, we decided to focus on building our consumer finance product, because that was the fastest growing and easiest to bring to scale. This is the coverage of Fair Finance's program. In 2010, we covered 1 London borough, so we're a London-based organization. We now cover 28. And we have branches in 7. And part of the reason for this is that in 2010, we were the first organisation in the UK to raise nearly £1 million of social investment to build a business, and managed to secure the first ever commercial finance transaction with no subsidy, with no government support, with no guarantee funds, with nothing except our funding that we raised. Within these 3 years, we've advanced 5 million of capital, made loans to around 7,500 people, maintained a low bad debt rate of 7%. In terms of kind of trying to think about the impact, simply by substituting our loans for these high-cost lenders, we've managed to save our clients nearly £8 million of interest. So these will be typically people who'd be unemployed or in marginal employment. We have put back £8 million into their pockets that they didn't have previously. We've opened 500 bank accounts. I put this here mainly to tell you that opening bank accounts is not the issue in westernized banked economies. Access to credit is. And we've taken maybe 4,500 people out of the hands of loan sharks and money lenders in the United Kingdom, in fact putting 3 out of business. I guess this is interesting, but this is our kind of income profile. So right at the beginning is when I raised the money. This is where we are today. So we're not there yet, but I can tell you that we are almost there, and next quarter we are predicted to post our first operating profit. And within the second quarter of the next financial year, we will be starting to repay our social investors. So we've done this within 3 years. We ran a small pilot around microfinance. This was a pilot test to see if the market could be sustainable. We did it for 5 years. On average, we employed 1.5 people, worked with 400 entrepreneurs, lent about £750,000, had a 9% default rate. In order to focus on the personal loans business, we stopped this and we relaunched this literally last week, October 2013. We raised £1 million of investment, and again, with the success of our business model and being able to prove to bankers that we were able to make a sustainable business, we've raised another £3 million of bank debt, this time from UniCred, with the support of the very well advertised EIF guarantee that everyone has access to. This is growing a team, of people who will be expanding across London over the next 5 years. We expect this business to be sustainable within 5 years. This is the business structure. We have a subsidiary charity. We have a subsidiary loan company offering consumer finance and a subsidiary business loan company offering business finance. And they are all controlled by a top company, which is a non-profit. It's not a charity, but it is a non-profit business. That non-profit business raises all the finance, and all of our bank finance goes into the subsidiaries. You can see exactly the same process here. This controls the mission of the business and makes sure that we are unable to lose or change focus in terms of what we want to do. Each of those subsidiaries is 100% owned by Fair Finance, the top company. And all of the social investment we raise has no voting rights because we don't want investors and funders to take control of the business. So in terms of just thinking about the financing model, we focus grants on the things that will never be sustainable. Our debt advice charity. We've used social investors as a linchpin to leverage other finance, and we've borrowed on commercial terms from banks, partly because we know that the industry that we want to tackle is a £2.5 billion industry, and there just doesn't exist that amount of grant or social investment in the whole of Europe in order to take on this business. But there does exist that in the private sector, so we are trying to prove that. In a sense, the first 5 years of Fair Finance, 2005 to 2010, were really test grant focused. The new funding model that we've done and the drive to sustainability has allowed us to raise nearly 8 times more than we would have done every year than we did over that 5-year period. The long-term planning this allows us to start thinking of interesting new ways to build our business. We are not anymore just thinking about consumer finance and business finance. We're actually now partners of the banks who recognize that over the next 5 years, due to changes in the law and the regulatory requirements coming out from Basel, they will have even less chance to work with these clients, and many of their existing clients they won't be able to make loans to. And they see Fair Finance in the UK as basically the best option compared to all of the bad options that exist out there to finance low-income communities. I got a few minutes. 3 minutes, wow. Okay, so here's some learnings. The first one is around financing. It's actually very hard to find any funders who will accept the true cost of small loans. Fact, they're expensive. Get over it. It's actually very hard to find any risk capital. Everybody says they want to give it, but nobody really wants to put any capital at risk. Nobody wants to do this. Everybody wants to make you a loan. What you need is an investment, and nobody's willing to do that. Very few European institutions get their head around this, and very few investors are available to do this kind of work. Banks struggle, so you better hope that you've got a very good relationship with the bank. Even the progress guarantee works a bit, but you need a lot of help to get this because this is way too small. I mean, we raised £3 million, which is peanuts. It's a commercial loan, yet this was the most complex deal that they'd done in a year. And for our sake, from our side, if a deal is less than 5 years, it's not worth signing the paper because you won't make this business work within 3. We've discovered that banks play a really important role as introducers, and as I think Elvin's already mentioned, part of our business loans portfolio book is going to come straight from all of the bank rejected loans. As an aside, our bank partners tell us now that they won't make a loan of less than £100,000, which means that anybody applying for a loan is not going to get it. They're going to have to be rejected, or they're going to have to put up some serious amount of equity of their own finance. MFIs are not banks, so they shouldn't be regulated as such. There currently exist no tax advantages for social investments. By definition, this work is with high risk, and it's technically subprime. This is the kind of stuff that banks are just not going to do anymore. If you remember, just 3 years ago, this is the kind of stuff that got everybody in the bank sacked. And if regulators want to understand what microfinance organizations are doing, they're doing extremely high-risk businesses that for the foreseeable future, banks will not want them back as clients until we've improved the credit ratings considerably. So I think there's some challenges in the funding and the regulation, but I think the biggest challenge is often within the MFI themselves. They must price for sustainability, otherwise they're not MFIs. They're highly subsidized, publicly funded, grant, philanthropy-based, unsustainable projects. I've found very few MFIs that have this unquestionable focus on credit and risk management. It's considered the difficult thing that nobody really needs to care about. But our bad debt rate is 7%, and that's pretty hard. And that doesn't work if you take your eye off the ball at any one point. We have total freedom in Fair Finance to design the product around our client needs. Until recently, we'd had no government money. So we had no other paymaster other than our clients to tell us what they wanted, which has meant that we've been able to grow at a rate of around 100, 125% per annum every year since 2010. And the thing that I've discovered is that if you don't get the right people in this business, especially when it's small, it's not really worth starting either. And that means the board, as well as the staff, as well as your backers. If they don't get the vision from early on, then actually there's nothing worth doing in this market. And if you can't remember what the mission is, it's no point talking about social impact, because at the end of the day, this seems to be the biggest discussion that funds consultants rather than practice. And if you don't believe in the mission that you're doing and the activity that you're involved in, you won't get anywhere. And ultimately, you need to remember that microfinance is a retail business, and there aren't really enough retailers involved in consumer finance right now. And just one last slide. And I leave you with this thought that credit is never enough. We've made loans and for a long time, and I think you need to realize that credit will only facilitate an idea, it won't create one. Making loans won't create entrepreneurs, ever. Only entrepreneurs create businesses. The best you can do is hope to facilitate that idea. And if you think that making a loan will create that idea, you're in the wrong business. You need to find a different way of creating ideas. And you need to remember that sometimes a loan is the wrong product. We prioritize not making a loan as much as we prioritize making a loan. And if you remember that your mission is not about making loans, but about supporting the excluded, then you'll think very hard about what products it is you design. In January, we launch a savings product. And in the year after, we'll be launching an insurance product, because we don't want to have to reject people because what they really needed was savings rather than a loan. And I think it's worth just talking very briefly about the importance of the client support services that sit around it. And for any practitioners out there to consider that microcredit is no longer the words we should be using, but something closer to microfinance. Thank you.